Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 30th, 2024. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever the videos get posted. And at the bottom of the emails, you'll also find which stocks are giving you overbought and oversold cluster signals in the S&P 500. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that go out of your way to click like and repost on this Market Outlook related content. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into tonight's session. First things first, I wanted to quickly remind those of you who are our charter members of our premium service that our renewals are going on right now, and for these first couple of months you get 25% off. I did receive an email here just earlier this afternoon, which spurs on this conversation. They were wondering what the coupon code was, but remember with this renewals offer, we've already manually adjusted the price lower for you guys, so you don't need to insert a coupon. You do need to go to the specific web page that we told you about in the email itself, because that's the only place where the discount exists. But there is no coupon code that is necessary for that. So anyway, if you have questions on that, make sure you seek out our email address of support@marketscholars.com, and we can get everything squared away if you're having any sort of issues with that. Also, we talked about this earlier in class today, so I still had the slide pulled up here as well. For those of you who are eligible for that discount, which would have been those of you who joined David and I at Market Scholars in 2018 and then renewed with us again in 2021, you are all eligible for this special 25% off discount. And tongue-in-cheek, joking aside here, this is the slide that we put together here to get you to think about the value that you derive from David and I with our 10 weekly classes where we're managing portfolios and teaching you about the markets. I looked online to see what the average price of a cup of coffee was here in the United States, and as you can see from good old Bing, the first entry that pops up shows that the average price, and I don't know if this is up to date as of 2024, it's probably even more now, but the average price, as you can see, is $2.99, and if you go to a gourmet coffee shop, it's $4.24. And so I had a little bit of fun with that, just showing you that if you are the type of person that buys a cup of coffee every day for $2.99, would you rather have access to David and I and our expertise within the markets for $2.40 a day? Because that's what the per day cost would be when you calculate it all out at this 25% off discount that is good for the next month or so. So a reminder that I am now in my 25th year of investing in the markets, and David is a little bit older than me, so he's actually got a couple more years than I do of investing. So between the two of us, we do have 50 years of operating in the financial markets, managing our own portfolios, and hopefully teaching you guys well along the way. So again, make sure that you're taking advantage of that opportunity if you want to continue with David and I for the next few years. Remember, our premium subscriptions do cover a full 3-year time period. All right, wanted to also bring something else up. This I will warn you a little bit in advance. This could be a little upsetting to some of you, depending upon your mindset, but have some news to share. That you won't be hearing much from me in the Market Outlook videos from this point forward. Now, before you jump to conclusions and you get too upset about that, be aware that this was a decision that I did not take lightly. This is something that I've been thinking about for a while, and I had mentioned it off and on over time. Many of you guys know that I have not been shy about telling you what my expectations are in terms of our audience in order to justify the amount of time that is required to do these free videos on YouTube. And as you're well aware by now, if you've been following me for any length of time over the last 10 years as we've been doing these videos, both here at Market Scholars and previously at TD Ameritrade, that the magic number that I'm looking for is 100 likes. And for the vast majority of years that I was doing this video, that was no problem at all. People were more than happy, more than willing to help us with that. After all, it's a free button. Most people, know that it helps us because we are very upfront with, telling you that so regularly. It's not some sort of a mystery or some sort of a hidden situation, right? David and I are always asking you to click like for us, and we expect 100 likes. And for the longest time, that was no problem whatsoever. We went years and years where 100 likes were very normal. In fact, I remember once upon a time we were up at 300 likes in one special occasion along the way when we were doing kind of a promotion thing. But the point is, it was fairly regular for us to get a normal, let's say 120 likes. It wasn't a big deal. Fast forward to where we're at now, it's become a much bigger deal. And we talked about this a little bit in our private Telegram channel here over the weekend as well, where I, again, reminded our premium members as to why we ask for the likes. Again, this is kind of what you would call a freemium business model, where we offer some stuff for free, but naturally, David and I need to get paid for our efforts in what we are doing with our careers as teachers, just like your high school teacher and your kindergarten teacher and your college professor, right? They all earn paychecks as well. David and I have every right to try to make money for our family as well. So we set out on this course to become entrepreneurs and start our own business, as opposed to being stuck in some nondescript gray building collecting a paycheck from a big corporation every 2 weeks, right? So we take a lot of risk in what we are doing. We're risking our livelihoods for ourselves, our families, and all that kind of stuff. So we really have to think hard about this type of stuff and how we're spending our time and all that kind of stuff. And sometimes you have to make hard decisions along the way when you recognize something's just not working anymore. And as just one example, over the weekend, since the last time I did this video on Thursday, you can see here we only got 80 likes. And this was after my plea with folks in our private Telegram channel, reminding them of why this is important to us. So despite us, kind of going that extra route and trying to rally the troops of our staunchest supporters, so to speak, even after that, it is still like pulling teeth to try to get people to click a button. And so if it's hard enough for our staunchest supporters to do it, you can imagine how difficult it would be to convince somebody else who's just randomly stumbling through YouTube to do it for us. So unfortunately, the support is just not to the level that we would prefer it to be. I went back to check, because I know it's been a while since we've been able to get 100 likes, and we'd have to go all the way back to November 21st was the last time we got 100 likes. 111, as you can see, that time around. So in other words, it's been a full 2 months, over 2 months, since we've been able to get our baseline medium of what we expect out of support to pour the hours into doing these videos. As I've mentioned to you guys many times over the years, especially with our longer form videos that I would do, those videos would take 3 hours of my day with zero monetary benefit of doing them, with only the hope that if somebody were to click like for us on Twitter, that maybe some other people would stumble across Market Scholars along the way. And you can imagine that's not something that's a normal occurrence. It's challenging when you are trying to run a business and you only have 24 hours in a day, and the main part of your business is teaching premium classes, to justify the amount of time and effort and hours that go into producing this free video, only to be met with kind of a yawn from your audience who's not always willing to help you along with the support. And that's only a minor fraction of you, right? For those of you that have loyally supported this over the years, I can't thank you enough. And I hope you have heard me tell you thank you many, many times along the way. And I think those of you that have regularly clicked like and retweet and all that kind of stuff along the way, you know how much I've appreciated that. So I'm not speaking directly to you. I don't want you to be disappointed. And remember, I'm not going anywhere. I will still be here at Market Scholars, so you'll still be able to get my same insights about the markets and analysis and all that kind of stuff, just like you have in the past if you're one of our premium members. So this is really going to affect those that are not our premium members more. And the other thing that I would mention is this is not some sort of a controversy between David and I either. He and I had a good conversation, probably about an hour or an hour and a half on the phone earlier today, talking about our business and our strategy moving forward and different things like that. And we were both in agreement on this point. So it's not like a situation where I'm really frustrated and I'm pulling out of the project or really mad or upset or anything like that. And it wasn't the opposite either. It's not David pushing me out of the project or anything like that. This was a mutual decision. Many of you guys know how this video was developed over the years. David and I used to work with each other at TD Ameritrade when it was called the Market Forecast video. And he was the one who started the video. And really, I came in a little bit after that. It wasn't long after that, but a little bit after that, helping him on days when he had meetings or was out of town or what have you. So I was kind of his helper in those early years. And I still kind of consider myself that today. The vast majority of you know that my focus on investing personally is on dividend growth investing and on long-term investing and on fundamental analysis. So many of you are probably scratching your head regularly wondering why is a guy like Brandon, who loves all those other things that I just rattled off, doing this YouTube video about technical analysis as often as he has. And believe me, I've asked myself that question a lot along the way as well. In fact, there were many times over the last 10 years that I was about ready to step away from the project, but I kept telling myself, as long as our audience is supporting us, I will do something that I'm not 100% passionate about, right? It's not my favorite thing on planet Earth to do. But as long as you guys were very passionate about supporting it, I didn't want to let you down. So that's why I've done this as long as I have. But truthfully, even when I was back at TD Ameritrade, I remember having a conversation with one of my bosses at the time that I was about ready to remove myself from that project and focus on things that I have more of a passion on. So this ended up getting delayed a lot longer as a result of your guys' wonderful support of me and this presentation along the way, and me not wanting to disappoint you. And so, hopefully you got a few extra years out of me, whether you knew it or not there behind the scenes. Now, moving forward, you'll see a lot more of David. So the video itself is not going anywhere. He may adjust the amount of times he's doing the videos and different things like that. But again, we just have to make business decisions that make sense for us and our families. And things are always fluid and changing, so bear with us as we move forward. But you just won't be hearing as much from me on this particular project in the future. I am planning, however, on kind of going a different direction. So some of you might be wondering, well, Brandon, are you just not doing this anymore because you're trying to be lazy and you want to go watch more movies or Netflix or something like that? No, of course not. Most of you that know me know my work ethic. I'm constantly working. So it's not a situation where I'm trying to get out of work or something along those lines. Instead, what I'll be pushing for, and I don't know exactly how this is going to work, so I don't want to make any promises or anything like that, but I am planning on producing a new format of this type of freemium video in the future that caters more towards what my passions are, which is dividend growth investing and fundamental analysis, long-term investing, that sort of thing. And I'm kind of shooting for mid-year, maybe second half of the year to do that. So most of you, this is not the last time you will ever hear of me. And again, for those of you that are already my premium members, you have full access to me all the time, right? Multiple times per week. Our question and answer sessions often last 3.5 hours on Thursdays as just one example. So I'm not going anywhere. Market Scholars is still going to be the same as it was before. The difference is I'm not going to be involved with this project here on the Market Outlook free video on YouTube as much as I was previously. So thank you for understanding that. It's been a heck of a run. It's been a good ride. I've actually learned a lot myself as well, so I do appreciate it from that perspective. The other thing I was going to mention is without the market outlook video and the previous predecessor to it, the market forecast video, David and I would not have gotten to know each other to the level that we did. It was because of our friendship and our partnership of doing the video that really allowed us to have the confidence to start our own business together as well. So I do acknowledge the importance of this video, and I respect it for that, even though I'm not the perfect fit for doing the video. And instead, you'll rely upon David's technical analysis expertise from here on out with the market outlook video. And of course, there's nobody better in the business with his CMT and his designations and his history and his knowledge about technical analysis. You're in extremely capable hands there. He's truly the best. I've said this in the past. I'll say it again since I won't hear, or you won't hear from me as much in the future. But in my opinion, when it comes to using the market forecast technical indicator, David is one of the world's foremost experts for that specific technical indicator. And when I say that, I mean there are not more than 5 people on planet Earth, in my opinion, that know more about that specific technical indicator than David. Sometimes that gets lost in the noise of all of this. Now, sure, it's a little bit more of a unique indicator that not everybody uses, so that's certainly part of the story, but it should not take away from David's expertise and his passion of following the market forecast technical indicator over the years. He is a true pro. He will continue to be. You are going to continue to learn tons and tons and tons from him about the market forecast technical indicator in this video moving forward, and I'm excited for you there. And I've learned a lot along the way as well, right? Again, it's not necessarily my forte or my pure interest in the markets, but it's always helpful to feel a little bit more educated about what you're looking at and helping you understand the markets from maybe somebody else's perspective, right? As somebody who focuses more on fundamentals, I've at least learned how technicians look at the market more closely along the way, and that helps me think things through a little differently when I'm placing my own orders for long-term investments. So all that kind of stuff I think helps us get better, whether we know it or not. There is value in education, without a doubt. It helps us feel more confident in life. And so anyway, I wanted to share that news with you. Again, thank you for your support along the way. Thank you for understanding this very difficult decision. It was not something I took lightly, but every so often hard decisions need to be made. And unfortunately, we just don't have the support any longer here at this current rate that we had previously expected and anticipated and actually had. It's just that it's slipped off here recently for whatever reason. And part of it may be just that there's a lot of content out there these days, right? Everybody, it seems like, has their own YouTube video these days. When David and I started these YouTube videos about a decade ago, there weren't nearly the amount of other people that were sharing their stock market analysis on YouTube. So luckily, we hit it a little bit early from that perspective. But now we're competing against so many other hundreds or thousands of other people that are doing similar things that I think there's only 24 hours in a day and only so many eyeballs out there to be able to watch a video. And so I think part of the story there is that, some people are just falling off and finding other content that kind of fits their style a little bit more as well. But, that's life. We have to be fluid. We have to adjust. We have to continue to work on ourselves, try to get better. Hopefully, we will continue to do that for you guys in one form or fashion moving forward. And I will look forward to continuing working with you premium members here in the years to come at Market Scholars as well. All right, now with all of the boring business out of the way, let's get down to brass tacks and talk about what happened in the market here today. So first things first, let's have a little bit of a look here at our heat map. This is the S&P 500 heat map. And by the way, since this will be one of the last times you hear from me in this format, for those of you that didn't know, and I've mentioned this a couple of times in the past, but just in case you didn't know before, this comes from finviz.com. Previously, I had pulled up the heat map off of Thinkorswim. and that works fine as well. I actually like to kind of mix and match them on occasion. They each kind of have their pros and cons. This one is nice for presenting purposes because at least on the bigger squares, you can actually see the percentage increase and decrease without me having to hover my mouse over it. So I kind of like that feature when I was sharing it in a format like this in the past. So anyway, for those of you that were wondering if you can look at this on your own, since I don't know if David looks at this type of thing during his presentation nearly as much as I do, you can pull this up. It's free over at finviz.com. You can kind of see the web address probably listed up there near the top. But if you just Google FinViz and S&P 500 heat map, this will probably come up as well. So let's dive into some of the details here. And as is often the case, let's start off with the Magnificent Seven. After all, they are the ones that push the market around the most and most influential on the end result of the S&P 500 as well, which did have an impact today. So I'll let the cat out of the bag now. The S&P 500 was down slightly today, but there were actually more stocks up than down, right? And so we know that on a day like that, it has to be because the biggest companies from a market cap perspective are the ones that were down and more heavily influenced the market to the downside, despite more individual components of the S&P 500 in the green today. So let's talk about the Magnificent Seven, starting with Apple. As you can see, down 2% here today. That's a pretty bad day for Apple, right? Apple is not the most wild of the Magnificent Seven out there. So a 2% move on Apple is actually kind of a big deal. So that certainly applied a little bit of downward pressure in the overall markets. Microsoft, which it's basically tied with these days from a market cap perspective, fared a bit better. However, we'll talk a little bit later about some of the stocks that were reporting in the after hours session, and Microsoft is one of those companies that reported after hours today. And the last I checked, it was down a bit. So brace yourself for tomorrow. It's not necessarily going to be a huge deal, but could be a kind of a follow through of a bit of a tech slump here tomorrow based upon some of the things we're seeing after hours here tonight. So those two big kahuna were both down today. The third Magnificent Seven company within the technology sector is NVIDIA. 0.49% to the upside for NVIDIA, so a 0.5% to the upside. That stock has been an absolute home run. Alphabet was down 1.16% today and down further in the after hours session because, like Microsoft, it also is reporting earnings here today. We actually have owned Google, NVIDIA, Microsoft, and Apple in my top-down trend trading class for over a year, so we have taken advantage of this entire push into AI. When we were in my top-down trend trading class for my premium members on Monday, we had a nice benefit when we counted out how many 52-week highs we had in our portfolio. We currently own 35 stocks. More than half of our portfolio is hitting 52-week highs, with the vast majority of them hitting all-time highs. And then we looked at it from a total markets perspective, where broader, there were about 22% of the market hitting 52-week highs. So we were duplicating the success of the broad market in that top-down trend trading class. And again, if you are interested in premium education, where we are managing portfolios for you and with you, then that would be a great class to start with. For those of you that were with David and I back at TD Ameritrade Invest Tools, you may recall the 3 green arrows strategy. So what I'm teaching now is very similar to it. It's not an identical replica, but very similar to that style in that particular class, where we've landed so many big winners along the way. So we've been very enthusiastic in that momentum-based class there on Monday mornings. So the other communication stock within the Magnificent Seven is Meta, down 0.24% here today. So a pretty moderate day for that stock that's really come firing back here in recent months. Remember, it wasn't so long ago, a year and a half ago or so, people thought that Zuckerberg had lost his way, and there was a massive amount of market cap that just disappeared into thin air. it's all back. They're back to all-time highs over at Facebook now, or Meta, as they call it these days. In the consumer cyclical or discretionary space, you can see that our Magnificent Seven component of Amazon had a tough day here, down 1.4%. And then Tesla rounds out our Magnificent Seven. It was up today by a measly 0.35%. However, Tesla of the Magnificent Seven has been the true laggard. It has actually ceded its market cap ranking to another couple of companies that were out there, like Berkshire Hathaway and some of those. So Tesla's kind of been sputtering more so than not lately. But today, a rare day where it was on the upside while most of the rest of the Magnificent Seven was on the downside. Now, outside of the Magnificent Seven, and especially technology-oriented companies, you'll notice, by the way, a lot of semiconductor stocks were down today as well. AMD, Intel, Qualcomm, Texas Instruments, they all kind of struggled here today. But outside of tech and Magnificent Seven, you had the vast majority of the market that held in there pretty nicely. Of course, you've always got your one-offs. Remember, we're in earnings season right now, so UPS certainly blew a flat tire here today with their earnings announcement as one example. So there are one-offs certainly out there, but the vast majority from a patterns perspective was actually a bullish day, right? Take a look at the financials. We had a really strong day out of the banks. Look at Bank of America, up 3.5% today. That is an outsized day for that company. Visa and MasterCard, stalwarts in the compounding growth side of portfolios, up another percent today. Berkshire Hathaway, up another percent here today. You'll also notice that a lot of the industrials fared quite well. We actually focused on industrials specifically in my Monday top-down trend trading class here yesterday morning, as that's been one of the hotter sectors recently. Caterpillar was up 0.5% today. Some of the defense contractors like Raytheon and General Dynamics and Lockheed Martin, Northrop Grumman, all doing quite nicely. General Dynamics, as you might have seen me post on Twitter here over the past week, is hitting all-time highs, and don't we know it? That was one of the many companies that we picked up in very cheap regards, especially knowing now in hindsight what we know, in 2020, when people were just throwing stocks away for no good reason. And we were able to scoop that one up, and we were thankful that we did, as it has come roaring all the way to all-time highs. Speaking of which, Nucor also had a tremendous day today. I was tweeting about that one a bit as well. Nucor was up 7% today. That is a new all-time high on that Dividend King. That one we bought closer to $40 per share back in 2020. You can see today it is priced at $189 per share, and that does not include any of the impact of the rapidly rising quarterly dividend in the 4 years since then either. So that one has been a tremendous winner for my premium students in my dividend growth investing class. Another dividend aristocrat that did extremely well today, also a dividend king, by the way, is Cisco. Now, this is not the Cisco of the tech world that you might be thinking of. This is Cisco Foods, the much smaller Cisco, in this case, ticker symbol SYY. Some of you saw my post there on Twitter earlier this afternoon showing what an ideal setup it was for somebody using our dividend stair-step charts that I supply all of our premium members with. In fact, in my dividend growth investing class just this morning, I released our 2024 version of the stair-step charts and spent a lot of time in that class going over the enhanced benefits of that. That is a rare chart that does need to be individually imported once per year because I'm running about 1,500 calculations on yields on a spreadsheet outside of that I need to feed back into the ThinkScripts and then share with my premium members every year for them to stay updated. But if you were to pull up Cisco on the updated dividend stairstep chart, you'll see that it basically went straight down, touched the blue zone in the fall, and immediately responded by going the opposite direction, in other words, back up along the way. And it had a tremendous day today. This is not a normal move for what is typically a very boring and stodgy dividend aristocrat. It was up 7.5% today, so a great move there from Cisco as well. It's also nice to see Archer Daniels Midland continuing the good vibes of what I told you guys about last time when I did the video on Thursday. For however many people might have listened to that video, I don't know, judging by the likes. I'm just teasing. But jokes aside, you guys will recall that I was bringing up my enthusiasm about Archer Daniels on Thursday night because right before I went to record the video, there was a late afternoon press release that came through that said Archer Daniels Midland was raising the dividend by 11%. And when I saw that, I about fell out of my chair because Archer Daniels Midland is in the midst of an accounting scandal that was just discovered earlier in the week. And I think the phrase that I used on Thursday to you guys was it was thumbing its nose at the SEC. So a little bit of a bold move there out of their board of directors, but the market seems to have liked it because it has rallied nicely since Thursday's close upon that information. So great to see that out of that dividend aristocrat as well, tacking on an additional 2% here today once again. So there's too many to get into. You can see the rest of the stocks in the list in front of you. It looks like oil did pretty well with the exception of Schlumberger, but most oil companies had a very strong day today as well. But again, today was a pretty decent day, all things considered. If you were to look at the breadth numbers now, back to the Thinkorswim platform, you can see here that out of the S&P 500, 272 stocks out of the 500 in the S&P 500 managed to close in the green today, with only 232 in the red. So that was good for about 55% of the market closing up today, despite the market being down. So again, kind of a unique day from that perspective, where it was the mega cap tech area that was kind of the cold, wet blanket today of sorts. And that might very well be the case tomorrow as well, by the way. So I had mentioned before over here that a bunch of stocks were reporting earnings tonight. Let's go through some of them. First of all, let's start with Microsoft, of course, one of the biggest companies on planet Earth. You can see here Microsoft is trading lower in the after-hours session, but not by much. The good news is it did recover its early losses. The lowest it got to in the after-hours session was 396. Right about here, maybe an hour or so after the market close, and it did have a nice rally, maybe another hour or so after that. Perhaps that's when the conference call started. I don't know for sure, but the point is it basically recovered all of its losses, and it ended the after-hour session at 407.64. The normal session, it ended at 408.59. So that was good. That was actually better than I was anticipating because I hadn't actually seen the pop since then. I saw the initial reaction lower. But looks like we're pretty flat right now in Microsoft. So hopefully that one will not hurt us all that much here tomorrow. Let's see what else is happening in the after-hours session. AMD is the next one on the list. This one's going to look a little uglier. This one's more wild, right? AMD is quite a tremendous growth story in its own right. Some of you may recall, as I do, maybe a decade or two ago, AMD was basically a penny stock. I remember it was trading in single-digit territory. So it's crazy to think the success that company has gone on in recent years is now it's a $172 company, and just as important as companies like Intel out there and things like that. So anyway, AMD, very wild company these days, but unfortunately for shareholders, it's wild to the downside here at the moment. Not only did they lose 3% in the normal session today, but they're going to drop even more than that in the after-hours session. So they were down about $6 per share in the ordinary session here today to create that 3% loss. To compare that to what's happening after hours, you're trading a little bit below 161 right now. So you're down about $11 per share after hours, which is about double the loss of the normal session today. So judging by what we know right now in front of us, we could be looking at about a 6% loss out of AMD when it starts trading tomorrow. So brace yourself if you have any involvement in that one here at the moment. Another one that I saw that was doing poorly after hours is Google. Of course, that's another one of those Magnificent Seven companies, and eventually, just this past week or two, finally got back to all-time highs itself, eclipsing its November 2021 all-time highs. But wouldn't you know, as soon as it does that, it reports a disappointing quarter, and it looks like shareholders are selling first and asking questions later, because this company appears to be down about $9 per share in the after-hours session. So AMD and Google are going to apply a little bit of pressure to the tech-oriented space tomorrow. Of course, Google is a communications company, but you could call it tech adjacent, or similar to the way that most people approach tech from a sector perspective. Another one that reported this afternoon, finally onto some good news. Some of you saw me tweeting about this one already this afternoon. Starbucks, how about that? Finally getting some life to it. We actually just bought Starbucks in the dividend growth investing class a couple of weeks ago, and so far our timing on that has been pretty good. Now, this is not the first time we bought it in that class. We actually first bought it when it was a $48 stock back in mid-2018. It was right after we had launched Market Scholars. So some of you may have a very low cost basis on Starbucks from that particular dividend growth investing class. But even in our current portfolio, we have a pretty decent cost basis on it. And tonight's activity is going to put a smile on our face, as Starbucks is up here closer to about $98 after hours. It did close the normal session at $94. So a decent little $4 per share move there. We'll take what we can get out of the coffee giant. Another company that reported after hours here today, Skyworks Solutions. This is another dividend growth oriented company. This is a company that has a fairly close alignment with Apple. They make a lot of the components that go into smartphones and things like that. Anyway, this company is up about $4 per share after hours on their earnings report here as well. Another one that reported after hours was Match Group. This is the online dating company. As you can see here, Match Group is basically flat. It ended at 37.73. It's basically right there in the after hours session as well. So actually the very final trade of the after hours session was exactly where it closed the normal session. So I'm not just exaggerating when I say it's flat. It is literally flat in the after hours. Now, along the way, it went all the way down to 36, and it also went all the way up to nearly 39, but it settled in exactly where it closed. So not a whole lot going on there for Match Group after their earnings. EA, which is Electronic Arts, of course, a big video game company, also reported tonight. They're down a little bit, so applying a little bit of pressure there alongside of Google and AMD. You'll see that Electronic Arts is down maybe about $2 or $3 after hours. So not a huge move lower, but a little bit of selling pressure there. And then last but not least, let's also take a quick peek at one of the big railroad companies. In this case, it's Canadian Pacific Kansas City. Remember, they were the Canadian railroad that was allowed to buy Kansas City Southern here a year or two ago. So they have plenty of exposure in the U.S. as well, but they're headquartered in Canada. And as you can see, their share price is up a skosh after hours, maybe a buck or two, depending upon where things settled out there. So hopefully that kind of stabilizes things in the transportation field a little bit. As I mentioned earlier, UPS was surely a disappointment in the transportation space earlier today. All right, let's now come on over here and take a look at the market forecast technical indicator on our 4Grid. For those of you that are premium members, remember this is chart 4B. I'm pointing that out because, again, I don't think David uses the 4Grid. I think he usually uses chart 4A. So since you won't be hearing from me as much in the future, some of you might be jogging your memory thinking, well, where did I see that 4Grid? How can I get my hands on that? And of course, the answer is by becoming a premium member at Market Scholars and coming over here to chart 4B. I like this view because I can kind of compare and contrast very quickly with my eyes. Sometimes when I'm going through chart after chart after chart on a one-off basis, I forget what the first one looked like by the time I get to the last one. So I kind of like it when I can see all four of them together like this. And it gives me a chance to see who the leaders and the laggards are and different things like that. So anyway, you can see the market was down a little bit today if you judge it through the lens of the S&P 500. It was down 0.06%. And you can see that that resulted in a loss of about 3 points. Not a big deal, but what I will say is it did hit a new high today. It didn't close with a new high, right? Because today was a slight sell-off, not a big one, basically flat, but just a skosh under the zero level. But since it did actually push a little bit higher on the intraday basis, notice that our high tag has now moved over here to the final candle off to the right, meaning that today is not just a yearly high, as this label is telling us, but it's also an all-time high. As we know, the market has been hitting all-time highs here recently after a 2-year delay in that. We finally got over the hump in the last couple of weeks, and we continue to push to all-time highs. So naturally, when that occurs, you might expect that the posture of the market forecast will remain the same, and that's exactly what has happened. As you can see, we continue to have a green background color on this chart. You can see that it has been consistently green. There has been no question, at least in my eyes, and for those of you that have watched my videos for the last 3 months, you will sense through how I'm analyzing it using this technique that it's been a bullish market environment. It doesn't necessarily mean it's the most rip-roaring bull market you'll ever be a part of, because there's parts of the market that aren't participating, but certainly from an S&P 500 posture setting perspective, there's been no question this has been a bullish market run, even before we hit all-time highs. We've been above the rising 30-day moving average for the entirety of the time since November 2nd. The day we got over that moving average right there that I'm circling with my mouse, you can see every single candle along the way, we've had price above that rising green line right there, which is the 30-day moving average. Not only was November 2nd important from the breach of the moving average perspective, but it was also the first time we got the bullish posture, right? Because in the fall, things were more bearish, but you know, we're not going to catch the exact bottom. It was a little bit lower a few days before that, but we had a strong enough rally during that period. We effectively changed the posture on the market forecast from a red background color to a green background color, because that green line, which was once in the lower reversal zone, emerged out of that lower reversal zone at that time. And since that moment of November 2nd, this has been one of the steadiest runs I've seen for this amount of time in the 10 years I've been doing the video. There's probably been a handful of times where maybe it's been more consistent, but not very many, I will say that. You can see that since November 2nd, which is basically 3 months ago, we have only had one extremely brief time right here where the chart went to pink, only for a day or two. Right? No technical indicator is perfect. You know, you had a little bit of selling in the week before that, so it kind of, you know, gave a little bit of a head fake or made the indicator think twice about the situation. But very, very quickly after that, it went right back to the green background. So this has been about as consistent of a bullish posture move, according to the market forecast, that I've ever witnessed, that we are a part of right now. And of course, in the early days, a lot of people didn't want to believe it. I probably even had my own skepticism about the move and all that kind of stuff, because we're human, right? We think to ourselves, it can't possibly be this good, that type of a thing. But, you know, day after day after day, the market keeps on proving it to you that it is bullish. And of course, that doesn't mean that it stays bullish, right? There's a difference between looking backwards and looking forwards. It is more challenging naturally to predict the future. But if you believe in trends and you believe in momentum and all these other things, relative strength that a lot of people in the world of technical analysis believe in, then it shows that we are in a firm position, right? The economy has its own challenges, but from a stock market perspective, we are in a very firm, bullish market environment at the moment. Now, of course, news and information is always changing. If a bomb went off in the wrong part of the world tomorrow, this could all disappear in a heartbeat. But right now, from an organic trading perspective, this has been an excellent run for the stock market. Moving on now to the Dow Jones Industrial Average. As you can see here, we also have the yearly high tag above it. And not only that, but like the S&P 500, it's an all-time high on the Dow Jones Industrial Average as well. So break out your Dow 38,000 hats and enjoy the celebration. Now, if you thought that the consistency of the bullish move out of the S&P 500 was impressive, then this is where the kids would say, hold my beer, if you're Dow Jones Industrial Average, because the Dow, unlike the S&P 500, has been bullish the entire time since November 2nd, right? I mentioned the slight flaw in the chart right there with the S&P 500, but if you look at the Dow, it did not have that slight flaw. It has been purely bullish this entire time, basically for 3 full months. That is incredibly rare. If you went back and you started backtracking throughout the months and quarters and years looking at this indicator, you will see it is not normal for a major market index to be bullish or bearish consistently for 3 straight months without any sort of a flip to the alternate posture along the way. So this has been something to behold, a thing of beauty. I talked about Caterpillar earlier in the session. You guys heard me talk about, I think last week I was mentioning IBM, right? These are not the most exciting companies on planet Earth, but they're Dow Jones Industrial Average companies. And some of you have seen me sharing the dividend stair-step chart on IBM here recently, showing how for years it was living in the blue undervalued zone, and then like a rocket ship, it has just launched into the orange zone of the dividend stair-step charts here with this latest surge in recent months. By the way, if Mike Emerson and Marcia Falk are listening, thank you, by the way, for your help with the dividend stair-step charts as well. There were some hurdles that I had challenges personally to get through when it came to some of our non-standard dividends and how some of the metrics were being calculated. But thankfully, I've got a good support team around me that's willing to lend a hand. So special shout out to you guys here tonight as well. But anyway, Dow Jones is hitting all-time highs. This is the 4th day in a row to the upside for the Dow, closing near the high of the session on all 4 of those days, keeping on pushing higher. You can see the entire time since it got above its moving average, it stayed above there. It touched it one time but didn't close below it. So, hard to argue, in other words, right? This has been an excellent move out of the Dow, and it's got plenty of momentum here at this moment. Now let's talk about the 2 charts on the bottom. On the left-hand side, we've got the NASDAQ Composite in the lower left. It was down 0.76% today. By the way, I didn't explicitly state this, but be aware that the Dow was up 0.35% today. You knew it was up because it had a closing all-time high, but you didn't know how much. So it was up 0.35%, which is decent for the Dow, 0.33% to the upside. So the NASDAQ, naturally, is we're going to find a lot more of that bearishness because you do have more of a tech impact on the NASDAQ Composite. And today was a day where tech was a bit out of favor. So NASDAQ Composite was down 0.76% here today. You'll notice that we had a bit of an inside day here from a candlestick perspective. A little bit more indecision there as it did hit a new yearly high here just yesterday, but not necessarily a great sign that you weren't able to follow through on that here today, right? Even the S&P 500, despite closing down a little bit, at least it could lay claim to the fact that it hit a new all-time high. The NASDAQ could not make that same claim. It still has its high tag over yesterday's candle. So we'll see where that leads us. The good news is it's got plenty of flexibility, right? It pushed so high above that moving average that you still have this pretty big air pocket between where it's trading right now and that upward trending 30-day moving average. You'll notice the NASDAQ actually had a yellow moving average for a brief amount of time, right? The S&P 500 did not. The Dow Jones did not. But the NASDAQ is going to be a little bit more volatile, both up and down. And you can see we pushed a little bit below the 30-day moving average for a couple of days there, changing that color to yellow, and then quickly corrected course back to the upside. You can also see that time of bearish posture. Now remember, this is a weekly bearish posture here, not strongly bearish. Occurred for a slightly longer length than what we saw here with the S&P 500, only a day or two with the S&P 500. But here on the NASDAQ, you had about 4 days where it was in that light pink color. So it wasn't quite as consistent there for the NASDAQ. But still, again, just give it the eyeball test. If you were to look at this chart and ask yourself, how much time do you see a green background color versus how much time do you see a pink background color? And do you think you would have been on the right side of the trade had you been using it to set your posture? Clearly the answer is yes. The NASDAQ has also been incredibly effective here, right? Very little amount of time in the last 3 months have you seen a bearish posture. The vast majority of the 3-month period that we're in the midst of right now has been bullish, and people have been fighting it all along the way, right? Much to their chagrin, as they now are aware. You should play into that strength, and hopefully many of you were able to take advantage of your skills that you've learned in these market outlook videos along the way as well. But today today was not the NASDAQ Composites day, down 0.76%. And as I mentioned earlier, it's entirely possible we have another sell-off day in the NASDAQ tomorrow based upon what we're seeing out of like Google and AMD after hours here tonight. So we'll see when that time comes tomorrow. But right now, just set your minds for that possibility. And then last but not least, in the lower right-hand corner is the Russell 2000. It's after hours now. Today was a busy day for me. I was all over the place. And as I mentioned, had a longer conversation with David on the phone that I normally don't have. And so my schedule is a little bit different today. So I'm getting this out a little bit later. My apologies for that. But the reason I'm bringing that up is if I'm doing it after a certain time, the Russell 2000 metrics go back and revert to zero. So I did write them down earlier today because I knew I'd be a little bit later. So I'll share that with you. And the Russell 2000 was down 0.76% today, basically matching the NASDAQ Composite. You can see here that was a red candle here today for the Russell 2000, basically sitting right on its 30-day moving average right now. In fact, it's actually a little bit above it. Some of you might be looking at the yellow color of the moving average right now and assume that it closed below it, but that's actually not the case. It's a little bit of an optical illusion of sorts. What's happening is the moving average is now going lower. You can barely make that out with a naked eye, but remember, you can right-click on these 4-grid charts and then maximize the sell. And now you can kind of see it a little bit better that yellow line is slumping over just a little bit. And you can clearly see now that I blow this up and zoom into it, that the candle is above the moving average. So when you have a yellow part of that moving average, it can mean one of two things. Either like back here, it had a yellow moving average when price was below a rising moving average. In this case, it's also yellow, but for a different reason. Now price is above, not below, but the moving average itself is actually drooping just a little bit. And remember, these are hard-coded within our scripts to be able to judge and compare one day's reading from another. So while it may not look like it to your naked eye, I've never seen an instance where the computer was wrong with this specific situation. So I trust it, and I can even tell with my eye just barely it is just a little bit lower. This is the type of thing that could easily get corrected to the upside, so don't read too much into it, but just thought I would share that with you in case you thought your eyes were playing tricks on you. So as we are aware, because we've been talking about it for several weeks at this point in these videos, the Russell 2000 is the weakest link of these 4 major U.S. equity indices here. With today's selling, we are back to a weekly bearish posture on the Russell 2000. Notice the background color going back to pink here today. Not dark pink, but light pink. And you can see that it's been kind of hit and miss really for the better part of the last month, ever since here on January 4th, where we went from bullish back to bearish. We've kind of flipped back and forth a couple of times along the way. That has not happened at all during the entirety of that time for any of the 3 other indicators. So it's made the Russell 2000 a lot different than the large cap indices that are out there. The small caps are trading differently than the large caps. Remember, you have 0 Magnificent 7 exposure to the Russell 2000. So it could very well be a truer reflection of what the typical stock is doing out there. Nonetheless, it's not what people will be talking about on CNBC, right? Because everybody likes to talk about the market is the S&P 500. And right now, the S&P 500 is pretty much the Magnificent 7. So it all kind of works together. But if you wanted a slightly different view of the markets, look at the Russell 2000, which has 0 Magnificent 7 companies in it. And here things are not quite as rosy as they may seem elsewhere. Here we are well off the highs of recent months. In fact, the high in this case, you'd have to go back to December 27th, so not even this calendar year. And we've been kind of languishing here in the last 3 weeks in particular, just kind of coasting sideways more than anything. So today was a day where you had kind of a little bit more benefit from kind of larger cap industrial style names, older school types of companies. not necessarily the mega cap tech oriented companies. So you did have the Dow kind of being today's leader, and that continues a bit of a theme. As I mentioned before, the Dow was the only one that can claim to have not just an all-time closing high, but also an all-time intraday high here today. So the Dow has been fulfilling on its role here recently, as some of the other indices have kind of started to second guess the move a little bit. You've got to wonder with the move being so strong recently when it's going to run out of gas, right? That naturally is going to be a question we're always going to have. Right now, the trends are certainly bullish, but things will change eventually. And when they do, I have no doubt that you will learn about it from David in these free videos on YouTube. You will continue to learn about it from me for those of you that are premium members at Market Scholars as well. So I'll wrap things up here. Wanted to give it a little bit of a longer presentation tonight, knowing that this was kind of my last hurrah, kind of explain things a little bit more thoroughly, because I know this news may hit a few of you with a bit of a jolt. But a reminder that I've asked you many, many times for many, many years, nearly every single time I did the video, that my expectations were 100 likes. So I think some of you probably knew, hearing some of my comments along the way, that maybe this day would eventually be upon us, as we just weren't quite hitting the numbers that I was hoping for along the way. But again, I don't want to discount the fact that many of you who did faithfully click like for me every single time along the way, I surely appreciate you. Thank you so much. It's heartwarming to know that you are supported in your efforts in what you are attempting to do, right? David and I are trying to do good work here, and it may not always seem like it, but a pat on the back or a thank you or what have you does go a long way with us. And as we always say, the best way to say thank you to us is by clicking like for us, because that gives us the added benefit of getting the word out to folks that are in your social media timelines and all that kind of stuff as well. But it's been a heck of a run. We've learned a lot together. I appreciate the opportunity, and I will be working with many of you for many years to come. For the rest of you, it's been nice to get to know you a little bit, and you're in wonderful hands with David moving forward as well. And stay tuned to what my next steps will be. As I hinted at before, this is probably not the last time you've heard of me. You will probably see me on YouTube or elsewhere with a different type of a product down the road that will be somewhat similar to this format, but catering more to dividend growth investors and fundamentalists and long-term investors, that sort of thing. So stay tuned. We'll announce things as necessary as time goes along. But that'll do it. That's a wrap. So for the last time, I will say best of luck with your trades and your investments. Goodbye for now.